We are back with our monthly market outlook in an extremely challenging and uncertain environment. As citizens of this great country, obviously we are very proud that Operation Sindoor was so successful, and we have given a perfect payback for the Pahalgam terror incident. Obviously, from a market point of view, that increases uncertainty. If tariff war was not good enough, now geopolitical tension we have to factor into while doing our forecast. If we look at global forecast, GDP growth estimates are slowly and steadily coming down, and inflation estimates are slightly rising. This is precursor for stagflation, growth falling, inflation rising. Next slide, please. The PMI continues to remain weak, reflected in slowing global growth. Next slide, please. The uncertainty, thanks to US policies and counter reaction, is nearly at all-time high. It's as uncertain as during the COVID time. The recessionary expectations are also rising globally, and today it has reached fourth highest in last 20 years, similar to COVID crisis or 2008 subprime crisis. Majority of investors are expecting hard landing, which means growth dipping well below its potential. The reaction of investors, obviously, at this point of time, is to increase cash, and across the region, across the globe, cash balances have started going up. Because of uncertainty, fund managers across the world has increased their cash allocation. Overall, US policies, counter reaction by countries, and supply chain disruption due to tariff war is all leading towards lower growth and higher inflation across the globe. Coming to US economy, since the start of President Trump's tenure, everything is falling. S&P 500 and Nasdaq have corrected. Dollar has fallen down and yields have gone up. Even yesterday at FOMC, rate cut didn't happen as per the expectation of the US establishment, not the market. Why is the market reaction across the board, debt, equity, and currency, so negative in US? One, the first quarter GDP growth for US came negative at minus 0.3% quarter on quarter. Year on year, it is still positive at 2.1%. When we look at GDP growth in India, we look at year on year numbers. But in US, they also look at quarter on quarter numbers. Maybe markets have corrected because they were expecting negative growth on a quarter on quarter basis. If we look at President Trump's policy, he is trying to change the fundamental challenges of US. US is spending much more than what it is earning. Hence, they have large fiscal deficit. Then they are consuming much more than what they are producing. That's why they have to import so many things. And that's why they run large current account deficit. In order to fund fiscal deficit and in order to fund current account deficit, they have to borrow lots of money. And that's why they have large debt to GDP ratio. US has reached a level where $2 of debt only creates $1 of GDP. लाख का 12,000 कितने दिन तक चलेगा? Which is why President Trump is trying to address current account deficit by levying tariff, hoping that with higher tariff, imports will come down. It is also hoping that tariff will help in funding fiscal deficit, and by cutting government expenditure through Department of Government Efficiency, eventually fiscal deficit will come under control. Essentially, what President Trump is trying to do is to clean the American fundamental imbalances. The tariffs which has been announced by President Trump has no precedence in the past except for two periods, which were 1930 and 1828. In both those periods of 1828 and 1930, after levy of mass tariff and counter reaction from rest of the world, it created recession or Great Depression in America. Can 2025 be different, or history will repeat itself, is the million-dollar question, or in America's case, trillion-dollar question. Because of levy of tariff and front-loading of trade during March 25, now US-China trade is collapsing, as visible in this picture. Levy of tariff in US and on US goods has resulted into shipping and supply chains getting disrupted. This has resulted into shipping rates coming down across certain routes. The reason why markets have reacted negatively, despite President Trump trying to correct fundamental imbalances, is probably inconsistency in their talking to the market or to the outside world. At different point of time, different parts of US government has given contradictory messages. This commentary on tariff alone confuses market, and that probably results into correction not only on debt but also on equity and currency side. With so much of confusion and crosstalk, no doubt the uncertainty about policies have reached almost all-time high level, just like COVID-19. This is famous painting of Jackson Pollock. Today's world or today's American policies is as easy or difficult as understanding this picture. Dollar index fell from 110 all the way to 99. This kind of mass drop or erosion in DXY index, the world has rarely seen. In fact, the reason why DXY correction started in early part of this calendar year was President Trump's announcement where he threatened Colombia with financial sanctions for not accepting Colombian immigrants. That shook probably global confidence on dollar. For small opposition to US policy, your reserves could be frozen. That lack of confidence resulted into dollar falling like a stone. Obviously, many more things were added, like reciprocal tariff or threatening to fire Fed chairman, which shook investor confidence on US dollar. With this much uncertainty, analysts are downgrading earnings estimate in S&P 500 firms. Inflation expectation in US is rising fast, thanks to supply chain disruption as well as tariffs. Next slide, please. Many Americans are now breaking into their 401k plan, which is equivalent to our NPS or EPFO balances. Normally, people break into retirement balances only when there is a desperation. Analysts fear that US unemployment will increase even without a recession. Inflation rising, growth slowing down, unemployment rising, people breaking into retirement packages, all these signs are not of a good economy. Global investors are now indicating that they would love to be underweight American equities. The US market has traded at premium to rest of the world. US share in global GDP is less than 30%, but US market cap as a percentage of global market cap is more than 2/3. That difference of less than 30 versus more than 66 is obviously driven by premium valuation. Will this valuation sustain if growth slows down, inflation rises, and earnings are downgraded? That's really a big question. Why should US bother about global investors? Well, more than 20% of their total equity market cap is owned by foreigners. 30% of US Treasury is owned by foreigners. And even 30% of US corporate credit is owned by foreigners. When you have such a large investment from global investors, you might as well take good care of them. In this whole dark clouds, silver lining is US Fed. It has maintained amazing balance between growth and inflation. They have raised interest rates, but taken liquidity in a very, very calibrated manner. The balancing which Fed has done between growth and inflation will become a textbook case for future central bankers. Now, the most important question for US investors, what will Fed do? Yesterday, they didn't cut interest rates as expected by US establishment, not by the market. Will Fed resort to quantitative easing, or they will pursue with quantitative tightening? Will they be able to balance between growth and inflation like before? Clearly, a lot of investor confidence and hope is riding on US Fed. Coming to Indian economy, we are truly becoming oasis in the desert. Growth remains high, inflation remains low, exactly opposite to what is happening globally. Next slide, please. Over last 10 years, India has doubled its GDP in dollar terms better than all its major peers. Undoubtedly, last 10 years saw India emerging as a global power. From 10th largest economy, today as I speak, we are 4th largest economy, just overtaking Japan because of rupee appreciation. In a few years, we will become 3rd largest economy, overtaking Germany. While last 10-year growth has been impressive, there is no running away from the fact that post third quarter FY24, our growth has started decelerating. This deceleration in growth seems to have bottomed out in September 25 quarter, in September 24 quarter, and hopefully from here onwards, growth should bounce back. The GST collection for FY25 came lower than nominal GDP growth. Fortunately, April 25 collection started with a bang with all-time high collection of 2,37,000 crore. Since goods import and export are small percentage of our GDP and services exports and imports have remained outside of tariff, one can say that impact of US tariff on Indian economy will be lower compared to other peers. There are some bright spots in Indian economy. One is rural economy. Rural wage rates have now started turning positive in real sense after almost 3-year gap. The tractor and fertilizer sales are growing reasonably. Agriculture exports are also taking off, which is supporting rural recovery. FY 26 monsoon is expected to be normal. The expectation for coming monsoon is above normal or above average. That's positive for rural economy. The crop output, Rabi crop 2025 season and Kharif crop 2025 season are likely to be better, which again supports rural economy. सोने पे सुहागा शायद इसे कहते हैं. Oil prices have come down between $60 to $65 a barrel despite all the global geopolitical situation. Lower oil is benefiting Indian economy. If we cut petrol and diesel prices, there will be more support to consumption. The lower oil prices supports us significantly. At $60 a barrel, the benefit to Indian economy in terms of lower import bill will be about $26 billion. The consumption sector also looks good. In the budget, finance minister gave tax cut of about 1 lakh crore to taxpayers. This is likely to be spent rather than saved, in our opinion, and that will give boost to consumption. RBI has cut repo rate by 50 basis points. The loan rates will be revised downwards to similar extent. EMI burden comes down. Most of the savings on EMI burden will be invested rather than spent, but some money will go towards spending. Between income tax cut, potential petrol diesel price cut, and also support to consumption with reduction in EMI burden is all good for consumption sector. The government continues to spend on infrastructure. We believe over next 5 years, despite fiscal consolidation, the infrastructure spending could go up by about 60%. There are some weak spots in our economy. One is the private capex. Despite lower leverage and higher capacity utilization, our private capex has not picked up as much as it should. And if we remove big houses, Tatas, Birlas, Ambanis, Adanis, Jindals, then rest of the India Inc. is even far behind on private capex. Clearly, there is a need to boost private capex. Instead of investing money in mutual funds and bank deposits, We have to encourage that this money is invested in plant and machinery. Of course, there are sectors like construction, education, water supply, manufacturing, where private capex continues to remain strong. But then there are sectors, including real estate, logistics, media, where private capex has slowed down significantly. One worry for us is power shortages. I'm sure on this call there are more than 1,300 people across India. Some might be witnessing power shortages. We ramped up our solar capacity, which is useful only during daytime, but non-daytime peak can't be met with solar in absence of storage. Those demands are growing at a faster pace, and hence some amount of power shortages could emerge, which will hurt our recovery. The most important worry right now is conflict with Pakistan. We don't have much experience of 1962, 1965, or 1971. Those were full-blown wars, and that resulted into our inflation going up, our fiscal deficit going up, and our GDP by and large coming down. In 1999, most of us have experienced. In the run-up to Kargil war between March 99 to April 99, Nifty corrected about 15%. Once India started talking that we will not cross LOC, but we will still recover Kargil, Dras and Batalik heights, market recovered about 8%. On 3rd May 1999, the conflict began. India showed restraint by not crossing LOC. Pakistan abandoned its soldiers. And throughout 3rd May 1999 to 26 July 1999, when Kargil war was going on, markets kept on rising. Market believed that this is a limited conflict, it will not go into full-blown war, and hence it continued to rise. Fortunately for us, GDP grew, inflation came down, and fiscal deficit remained where it was. On back of solid economic fundamentals, market rallied. We don't know how situations will change, but based on the past experience, if there is no escalation, then market's reaction will be muted. If there is a full-blown war, undoubtedly there could be some correction in the market to the extent of war. But do remember that despite 1962, 1965 and 1971 full-blown war, Indian economy as well as Indian markets have rewarded its long-term investors. For us, the challenge remains our trade deficit with China. It's running upwards of $100 billion. Clearly, we are in a very difficult situation with China. Neither we are friend nor we are enemy. Should we run this kind of large deficit with China? Could they suddenly stop exporting to us and put us into a troublesome situation? Another weak spot for Indian economy is freebies. Every state to win election announces freebies. When we spend money on freebies, multiplier effect is 0.9x on GDP. When the same money is spent on infrastructure, multiplier effect is 3x on GDP. Today, while central freebies have come down, state freebies have gone up. We must ensure that there is a balance between infrastructure spending and freebies. Coming to equity markets, they have witnessed correction between October 24 to March 25, and thereafter there is a recovery. Our market cap to GDP ratio is 126% at this point of time, whereas historical average is about 87%. We believe bearing geopolitical events like Indo-Pak war, US tariff, there is limited scope for big correction in market. Stocks are slaves of earning power. India Inc. profit from 4 lakh crore in 2020 have grown to about 18 lakh crore in this year. This 4.5 times growth in profit is reflected into market cap. As long as this profit doesn't come down, there will be limited scope for correction, deep correction in market. Valuation-wise, large cap trades around historical average. Mid and small cap are at a slight premium to its historical average. To some extent, this is also driven by high PE sectors like retail coming into index and low PE sectors like banking or metals going out of the index. It will be suffice to say we are neither cheap market nor expensive market. We are somewhere in fair value. This is reflected in number of stocks trading below 20 trailing multiple PE. It is one of the lowest level. Historically, about 39% of stocks trade below 20 PE on a trailing basis. Today, it is just about 24%. This is to highlight that despite higher tension and uncertainty, our markets are trading little above fair value. The Nifty 50 earnings for March 25 quarter is expected to grow at 6%. So far, about 108 companies' results have come. They have come reasonably ahead of expectation. There are few companies which delivered below par result, but collectively, 108 companies have delivered results which is little ahead of expectation. This quarter earning is expected to be about 259 rupees. This will take FY25 earning to 1015 rupees, and next year's earning is likely to be around 1165. This supports market from a downside as earnings growth continues to remain fairly robust. FPIs have been big sellers of Indian equity since almost COVID time. In between, they came to buy, but overall, they have been selling. Today, their holding is now lower than collective holding of domestic institutional investors in almost 2 decades for the first time. Domestic institutional investors' flow remain very, very strong. All of you are working on the ground to handhold customers and spread knowledge about long-term investment. This has resulted into us standing in front of FPI. While FPIs have been selling India, we believe सुबह का भूला शाम को घर लौट आएगा. There is a cycle in emerging market performance versus developed market. Sometimes developed market do well, sometimes emerging market do well. Over last almost 14 years, US market has done better than emerging market. Maybe that vanvas is coming to an end. That exile is coming to an end. And now investors may look to invest in emerging markets, including India. Last 10-15 days, including yesterday, suggested that FPIs are consistent buyers. Maybe this exile is coming to an end and सुबह का भूला शाम को घर लौट आया है. The other way to look at FPI's behavior Between October 24 to March 25, US equities were likely to go higher because President Trump was going to announce tax cuts. Dollar was likely to appreciate because President Trump was going to make America great again. On the other hand, US equity, Indian equity was looking expensive. September 24 and December 24 results were subdued, and rupee was also looking vulnerable. It made sense to sell India and buy America. Today, situation is reversed. Rupee is stable, well under control of RBI. Equity markets are looking attractive for long-term investor. Valuations are fair. On the other hand, dollar is collapsing and US equity market is looking expensive. Now, maybe the trade is sell US and buy India. Finally, we still believe FPIs will be buyer of Indian equity on correction at attractive valuation because of the growth opportunity. China over last 10 years has shown 17% growth in CSI 300 index EPS in renminbi terms. US S&P 500 earnings growth is 129% in dollar terms, and India's Nifty 50 earning per share growth is 176% in rupee terms. No price for guessing which side bread is buttered. Domestic institutional investors led by mutual funds have cash balance to take care of any uncertainty. Between balance advantage fund and hybrid funds and active managed funds cash balance, we have dry powder of about 2,68,000 crore. Obviously, we are not here to give exit to foreigners. We are here to make money, but it shows that there is enough dry powder in the hands of mutual funds. One point which we would like you to reiterate in front of investors, last 5 years have been exceptional. Almost 290 plus stock in BSE 500 have doubled. This is one of the most broad-based rally we have seen. Even today, 171 stocks are trading above 50 valuation. Next slide, please. Last 5 years return between Jan 20 to March 25 were about 16%, led by small and mid cap at 20% plus. Before that, for 15 years between 2005 to 2020, broad market delivered 11% return, led by large and mid cap at around 11% return. Small cap underperformed them, and which is why over 20-year basis, market has delivered 12% return, and the difference between large, mid and small return is very, very narrow, just about a percentage point. If you are coming with 20% plus return expectation, you are likely to be disappointed. The returns are more likely to follow 20-year trajectory rather than last 5-year trajectory. Please request your customers to have right return expectation in their mind and don't have exaggerated return expectations. Our markets will be driven by events, Trump policy, whether India-US FTA is as good as India-UK FTA, FPI flows despite Pakistan's provocations, Indo-Pak tension, do we go to full-fledged war, consumption expected to get boost from tax cuts, lower EMI burden, petrol diesel price cuts, and finally, 8th government pay commission proposals becoming effective in 2027. Geopolitical risk of Israel, Hamas, Ukraine, Russia continues. And finally, earnings growth. Will we deliver 1150, 1160 EPS for Nifty 50 this year? All this thing undoubtedly will keep our markets volatile. But for long-term investor, every correction will be great opportunity to invest. We do recommend following dharma of asset allocation and use your non-equity allocation to buy during correction if you want to be overweight equity. At this point of time, we remain overweight large cap, marginal underweight mid cap, and underweight small cap, looking at uncertainty as well as the valuation. From an investment point of view, on a rolling return basis, across our equity fund, we continue to add value to our investors by outperforming benchmark indices. Next slide, please. We do same in hybrid as well as rest of the equity funds. If we look at point-to-point returns, again, bearing few exceptions, across most time periods, across most of our equity funds, we have delivered better return than benchmark index. This is true for other equity and hybrid funds. Even on an SIP basis, across most of our funds, we have been able to add value to our investors. This is the number for hybrid and other equity funds. Unlike the narrative where fund managers are portrayed as underperforming benchmark index, the data is visible in front of you. More importantly, this data does not capture the constraints in which we operate. For example, in index, there is no cash. Fund keeps cash to meet day-to-day redemption. Straightway, your performance comes down by 50 to 100 basis points. In index, stocks can be 12% and 14% also, like Reliance, like HDFC Bank, like IOC. But in fund, you can't go above 10%. Fund have to book their profit. Index doesn't have to do that. In index, stocks enter and exit at closing prices. In fund, we have to incur transaction cost. We have to pay brokerage. We have to pay STT. That transaction cost alone brings down fund's performance. Finally, in the world, fund performance is gross of expenses. In India, we compare it net of expenses. Despite all those challenges, mutual fund managers have outperformed benchmark index in most of the cases across most of the funds, and which is where we need your help and support in popularizing this message, in conveying this message to the investors. At this point of time, large and mid cap will be appropriate fund to look at. Multi-cap also will be an appropriate fund to look at as it gives exposure across large, mid, and small. Thematic point of view, consumption and banking and financial services are the two sectors where we are bullish. On the passive investment side, we remain one of the lowest cost passive services provider. We have large, mid, small index. We have smart beta indices like momentum, low vol, alpha, value. We also have gold and silver ETFs and fund of funds. And we were the first asset management company in India to launch ETF on MSCI India Index. We also have sectoral and thematic fund. We also have sector and thematic funds as well as ETFs. Do look at them as they are one of the lowest expense and lowest tracking error funds in the industry. Coming to debt market, US inflation, thanks to the efforts of Fed, has come down. But because of the tariff uncertainty, Fed is unable to predict future path. Market is still discounting Fed will cut rates this year between 75 to 100 basis point, but it looks more back-ended than front-ended. In India, inflation has dropped down to about 5-year low. Obviously, from bottom, inflation can only rise, but it should remain well within RBI's target range this year. Crude oil prices have corrected. The drop in crude oil prices not reflected into inflation, as local petrol and diesel prices have not been revised downwards. Hopefully, those petrol diesel price cuts should come, positively supporting inflation. The RBI believes FY26 forecast will be somewhere around 4%, right near the middle of their target. Last year, we had 4.8% inflation. This year, 4% is showing reasonably good fundamental. RBI is super active on liquidity front. They have pumped in more than 6 lakh crore through variety of measures from open market operations to FX intervention to swap. This support of RBI on liquidity has brought 10-year yield below 6.5%. They have managed liquidity quite nicely, and from being negative, it's now firmly into positive territory, which augurs well for interest rate. In the debt, income arbitrage fund is something which you should look at. This is one fund of fund where after 2 years, your capital gains will be taxed at 12.5%. That's fantastic opportunity for the debt investor. Do have a look at it. It is also one of the largest fund in this category. Hybrid schemes also provide good opportunity for investors looking to get extra return over debt, albeit with some volatility. Kotak Debt Hybrid Scheme, Kotak Dynamic Bond Fund, Kotak Balance Advantage Fund, and Kotak Equity Savings Schemes. These are all appropriate fund for investors who are looking at regular cash flow. If they can do systematic withdrawal plan on these funds, it will really be beneficial to them. We have been bullish gold since COVID time, bearing 2021 calendar year. That call has worked wonderfully well. We still believe gold has potential to go to higher prices thanks to geopolitical tension. Central banks have been buying gold at almost 1,000 tons a year, led by China and other parts of the world. This 1,000 tons plus gold buying is pushing gold prices to higher level. As of today, every Tom, Dick and Harry on street is long gold. Normally, such consensus is negative. We believe there could be correction because of this kind of consensus. But the long-term story of growth, higher geopolitical tension, central bank buying, American interest rate coming down, continues to be supportive of higher gold prices over longer term, despite near-term crowding of the trade.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.